Good evening, everyone, and thanks for joining us for another educational webinar. This month, we are focused on the real estate category and more specifically, using a self-directed IRA for apartment building syndications and investing in apartment buildings. Tonight, we have with us our guest, Seth Martinez, who is one of the founders of People's Capital Group. He's going to be talking to us about some of the specific investment types and best practices. You may have noticed that we originally were scheduled to have Aaron Fragnito. He is the other founder of the organization. Unfortunately, Aaron was unable to join us tonight, so Seth is filling in. And then we are going to cover the real estate information along with some self-directed IRA information and concepts. We're going to try to leave some room at the end for questions, but the broadcast is also being recorded. So if you're unable to join us live tonight, as long as you registered, you will automatically receive a copy of the recording. And if you do have any questions, you're free to enter them into the question box on the right side panel of your screen. I am Brittany Piquel, the Director of Marketing and Sales with Next Generation, and we will both be providing you with some valuable education tonight. So we hope you find this hour valuable. And with that, I will let Seth get started, and we'll take it from there.
All right, thank you, Brittany. So my name is Seth Martinez from People's Capital Group. I am one of the two founders, as Brittany said, and thank you all for coming to attend the webinar. If you live in New Jersey, you know today was a beautiful rainy day, and I'm a little facetious there, but we actually had so much rain that we had a technical difficulty about an hour ago, and we weren't sure we would get online, but we are. So hopefully that technical difficulty with the rain doesn't resurface and we can complete the webinar. And we're also doing this late in the evening here, so I'm working from home and I have two dogs, so if there's any background noise, that's my two dogs. So let's get started. And before we actually get into the details, this is just a disclaimer that this is not a solicitation of funds. This is something our attorney makes us post to all seminars and webinars and presentations. We are not brokers or security sellers, and everybody should do their own due diligence before making any investments. So People's Capital Group is a full-service real estate company. It's located in northern New Jersey. It was founded in 2013 by Aaron Fragnito, my business partner, and myself. And what we do today is a little different than what we did 5 years ago, but it's still real estate. And what we do now is we buy and sell a lot of real estate, and we also help people get started and invest in real estate for the long term. So Aaron has a background, just briefly here, as a realtor. He was a top realtor in his brokerage at RE/MAX from about 2010 to 2014. And he became my realtor. In fact, he was really the only realtor that would accept all of my offers when I got started about the same time in 2010, 2011. So we developed a good relationship, and we realized we worked very well together, and we started our own business, People's Capital Group, in 2013. My background is from New York City. I had a healthcare business from 2005 to 2010, sold the business, moved to New Jersey, and started a real estate company. So let's continue here. And tonight we're going to really base the whole webinar on a single problem, and that problem is that, quite frankly, most people are not satisfied with their investment return. And this crosses all industries, and it crosses, for the most part, all wealth spectrums: blue collar, white collar, technology industries, all kinds of industries. If you take a sample, most will say they're just not quite happy or satisfied with their returns. And here are some examples of average returns that people get, again, across all spectrums. Savings accounts produce roughly a 0.05 to 2.45 annual return. CDs, certificates of deposit, a little bit better, but not too much better, 1 to 3.25. The more money you invest in those, the higher rate you get. Municipal bonds, a little better still, a little more difficult to find, up to 4.9%, and then stocks can be better than all the other three. It can also be worse. As we saw last year, it was negative, so it's very unpredictable, and they also come with fees when you're buying and selling stocks, and or when you have an asset manager managing your portfolio. And then there's one other factor that has to be taken into consideration when you're looking at your returns, and that is inflation. That's a hidden cost, and it's since World War II at about 3.6%. And as we can see, if your average investment from the prior slide was anywhere from 1 to 3 or 4%, you're pretty much breaking even or losing money when you factor in inflation. Now, what holds back most people from making a better return? Well, they're hard to find. A lot of people are busy working. There's also uncertainty of how to find, a good investment. Even when you find one, you want a little uncertain as far as how to go ahead and invest. And one thing that comes to mind might be Bitcoin. Another thing could certainly be real estate. We're going to talk about that tonight. And then a fear of investing alone, fear of making a mistake, and then the time factor. Again, a lot of people work full-time jobs, and they don't have the time to manage the investment. And of course, there's other factors as well. So what is the solution? It's a strategy that offers an alternative to make a better return through real estate. Now, a couple things on real estate. It has a track record of creating more wealth for more people than any other industry. It's created more millionaires than any other industry going back to the beginning of time. However, as it says here, many people who are not in real estate can find it very difficult to get into, can become unattainable. On the flip side, it can be attainable if you have the right strategy and the right relationships with the right people or the right companies. And the ultimate goal with real estate is to create a passive real estate opportunity where your money is making you money through real estate without you having to do all the work and put in a lot of time or any time. And so what we'll do now is we'll just break, and Brittany, if you want to go into a little more about the 401k and how we can tie that into real estate, and then
Sure.
we can revisit. Okay.
Sure, absolutely. So what we're going to do here, can you see my screen, Seth?
Yes.
Okay, great. So we just talked about the real estate industry and the market in general. And obviously, a lot of people have experience and interest in that in terms of using personal funds, but we're also going to talk about how you can use retirement funds to do these investments from a passive perspective and potentially get those same benefits that you're getting with your personal funds, but with the tax advantages of using a retirement account. So for anyone who's not familiar with Next Generation, we are a custodian and administrator for self-directed retirement accounts. It is our specialization, and custodian and administrator just means that we're a financial institution that holds the retirement accounts and provides processing transactions, deposits, withdrawals, etc. So we move the funds for our clients and their accounts by their direction when they tell us what they'd like to do with their funds on behalf of their accounts, and we do all the tax reporting, record keeping, and documentation on those accounts as well. Just a quick disclaimer from our end too, although we are a financial institution, we are not financial advisors or fiduciaries, so we don't endorse or recommend specific investments, but rather our mission is to provide the administrative customer service around the accounts and also to provide valuable education around the best ways that these accounts can be used from a compliance standpoint in terms of making sure that you understand the regulations and you understand the process for setting up a self-directed IRA, what your responsibilities are as an account holder, and sort of best practices for getting everything in order to make an investment if this is something that you choose to do. So the company has been around for 15 years. We're a women-owned business. We're also based in New Jersey, up in Roseland. And we are mainly focused on self-directed IRAs, but since we are also a trust company now, we do provide other trust services. Our founder and CEO, Jamie Riskulnik, is also a real estate investor, and she founded the company out of a desire to make real estate investments within her own retirement account. So you'll see us in several different publications in the finance industry. Here's an example of a podcast I was featured on, real estate related as well. And we do a lot of sort of regional and even some national level conferences and outreach related to self-directed IRAs as a strategy. So the company has two parts. They're basically sister companies. The custodian is Next Generation Trust Company, which is a trust company chartered in the state of South Dakota. Although we can hold accounts in any state, we're bound by the laws of South Dakota as far as how we run our trust charter. And then the services division is our administrative arm, and that is the office located in Roseland, New Jersey, where I work along with the rest of our staff. And if you were calling about anything related to your account or sending any correspondence related to your account, it would be sent to the New Jersey location as well. So what really makes a self-directed IRA different than an IRA that you might already have in a brokerage account, for example? So it's really what it allows you to invest in. So if you think about the things you're typically restricted to, which are stocks, bonds, and mutual funds, typically anything that's publicly traded, if you think beyond that and you think about non-publicly traded assets and realize that your IRA or self-directed IRA will allow you to invest and hold those things as long as you have a self-directed custodian, then you have the ability to sort of open up your options. And what that also does is potentially give you a hedge against stock market volatility. As Seth mentioned, you can get great returns in the market, but sometimes they can be unpredictable, and we do see a lot of fluctuation. So one way to potentially mitigate some of that is by putting some of your retirement funds into alternatives, which can be more stable over time. And then, of course, all the investment earnings that are made with a self-directed IRA are tax advantaged or tax-free, and depending on the account type, and they flow back into the retirement account and help to build the value of that account over time to build long-term wealth. So why is this important now? I think it's always been, but it's becoming increasingly more popular of the strategy because we are seeing a change in the retirement landscape. And we're seeing the ranks of people age 65 and older who are working or seeking paid work doubled from what used to be 10% back in the early 80s. Now it has cracked 20% again. So we are seeing that, baby boomers, a lot of them are still working, even after they qualify for Social Security benefits, and future generations are not counting on Social Security or pensions. So there is an onus on the investor or the individual to try to find alternate ways to close the gap between where they need to be for retirement and where they currently are. So if you choose to self-direct, you can open any of these types of accounts: a traditional tax-deferred IRA, a Roth for tax-free investment earnings, SEP, simple or employer-qualified plans if you're a business owner, which give you some additional contribution potential that you might not have in a traditional or a Roth IRA. And then also the ability to establish a child's education savings account, which can be self-directed, and health savings accounts as well. Ways to get funds into an account: if you establish a self-directed IRA or retirement plan, you can, just like any other retirement plan, you can make a personal contribution, and those are within the IRS limits that are set for each account type. You can transfer between similar accounts. So if you have an IRA at Fidelity, for example, and you set up a self-directed IRA, you can potentially transfer some of the funds from your Fidelity IRA into the self-directed, and you can use that cash in order to make new alternative investments. If you have an old employer plan that's no longer active, whether it's a 403B, a 401k, 457, that can be rolled into a self-directed IRA. And then, of course, if you have a tax-deferred plan and you decide to open a Roth, those funds can be moved into a tax-free account in what's called a conversion. So in terms of possible investments, there are only two restrictions, as you can see here. Life insurance and collectibles are the only things that the IRS is not allowed to be held in an IRA. So real estate being number one, because it is the most common, and there are so many things that you can do with real estate, and there are so many people out there that already invest in real estate, and pretty much everyone knows and understands real estate to a point, and it's something that they can see and touch. So a lot of people like to invest in things that they can see and that they know are there and that they can evaluate themselves. In addition to the real estate space, though, we do have a lot of investors in private equity, so investing in startups, limited partnerships, private stock, hedge funds, whether they're domestic or international, precious metals like gold and silver, notes, so lending, which can fall into the real estate space as well, but even can be just private lending, and all sorts of things, as you can see. Just keeping in mind that when you direct your custodian to process a transaction out of your IRA, purchase an asset or lend funds out of your IRA or make any sort of investment, when that does yield a return, all the funds associated with that IRA's investment go directly back into the account, and that's what keeps the tax advantage status of that retirement plan. So there are some restrictions that the IRS puts forth as far as how you can use a self-directed IRA to invest, and it's mainly related to the relationship between your self-directed IRA and the person or company that you invest with. So if you're looking to lend funds out of your IRA to an individual person, that's fine, but it can't be what's considered a disqualified person. So the IRS defines disqualified persons as you yourself personally, and then primarily ascendants, descendants, and their spouses. So if you think of it in a lineal order, most family members, with obviously some exceptions, are disqualified. So they're not able to directly transact with your self-directed IRA or directly benefit from your IRA's investment. Fiduciaries of the account, like advisors as well, entities that are majority owned by any combination of the above, and then people that are providing service to the account. So if you are doing a syndication, an example of some of these restrictions would be if you're using your IRA to invest into a project sort of similar to what Seth's going to be talking about here in a moment in a little more detail. You cannot personally be an active partner, director, or managing member of that LLC or that group, right? So you're coming in as more, your IRA is coming in as more of a passive investment or a limited partner. And then just remember that those earnings on the investment, whether it's in the form of dividends or equity or just interest in principal, cannot be paid directly back to you personally. They must go back to your IRA, which is the true investor in that case. The consequences of a prohibited transaction, if you were to do any of these things that are considered restricted, would be that your IRA basically becomes dissolved as if you were to take a full withdrawal of the amount. So depending on your age at that time and when the prohibited transaction occurred, there can be pretty severe penalties. At a minimum, the early withdrawal penalty, if you're under the age of 59 and a half, which is 10% of the amount, and then any taxes that are owed on that amount. And if the prohibited transaction occurred in a prior year, potentially back taxes. So not to scare you, but just to stress the importance of being educated on the rules and regulations. And then, of course, if you're not sure about something, relying on your custodian for assistance and guidance to make sure that you consult the right resources. I'm going to sort of gloss over this, but I just wanted to make sure that I did sort of touch on this. There are two types of tax that could apply to a self-directed IRA's investment. This isn't usually the case, but in the case that you were to use your IRA as almost like an operating company, so if you were to use your IRA to buy a franchise of some sort of fast food chain or something like that, and then you were to fully run that out of your IRA and make regular income, the IRS would look at that as regular operating income, and they would apply a tax to income associated with that. The same would apply if you were to leverage any investments with debt using your IRA. So in the case where you might purchase property and you need a mortgage, if you were earning income based on some debt that you had taken on, then that portion of the income attributed to the debt would potentially be subject to what's called unrelated debt finance income tax. Now, if this is the case that the tax is due, the IRA owner files a 990T, and the IRA pays the tax, but this is a good conversation to have with a tax advisor if you are not sure whether that would be something applicable to a specific investment. So if you are looking to make an investment like what we're going to talk about tonight, basically there would be a set of internal documentation that you would submit to Next Generation as sort of like a direction of investment. So you'd let us know you want to invest in ABC company for X thousand dollars, and you want the funds sent to a specific bank account or a specific entity. And then the supporting documentation we would review. So you'll see if it's going to be in an LLC or you're investing with a company, we would review their operating agreement, certificate of good standing. If this is a private placement, we would look at the subscription agreement if applicable, private placement memorandum. If it's going to be in the form of a note or a loan, we would look at a copy of that note and the terms of the note. So those are things that we're reviewing from a compliance with IRS guidelines standpoint to ensure that we're doing everything to protect the tax advantage status of your account, that the IRA is not engaging in what would be considered a prohibited transaction, and that the name of the IRA is reflected accurately on all that documentation. So that's part of what our services that we provide, and that is a review that is done prior to processing the transaction. So the timeline for setting everything up really varies, as you can tell. Opening the account just requires filling out and electronically signing an application. Everything can be done online through DocuSign, and that takes 1 to 2 days. Funding the account, depending on which method you choose, we covered those briefly earlier, contribution, rollover, or transfer. It ranges so much because it depends on the other custodian's processing times. So wherever your funds are currently held, that organization has to let them go and send them over to us. So we try to help expedite that as much as we can. And then making an investment itself, when we receive that paperwork I talked about that would be required for us to do that review time is 2 to 5 business days. So depending on how much correction needs to be made to the paperwork, sometimes doing the first investment may take a little longer because you're getting used to the processes. We could process that within a week or 2. So I wanted to just gloss over that because I want to give staff more time to talk about the specific real estate opportunities and strategies, but I just wanted to make sure that we covered this as a tool that you can use to apply, whether you decide to use your personal funds or you decide to use a self-directed retirement account. You can reap very similar benefits. So here's our contact information. We'll also be sending a follow-up email after the webinar, and please enter questions in as you have them. I'm going to turn it back over to Seth to continue on talking about the real estate piece.
Okay, thank you, Brittany. So let's move into some of the benefits and technicalities of how the real estate can make money with the IRA. In summary, the benefits are that an investor has their money backed by the tangibility of real estate as opposed to a stock, which is not tangible, or a passive and better return on their money. Now, there's 3 ways that an individual will make money in real estate when investing or self-directing their IRA. One is cash flow, which is the rents minus all the expenses. Second is equity appreciation, or equity growth, as it's also known, which is the increasing value year over year of a real estate asset. And tax depreciation, which passes through with the IRA, which we'll talk about down the road. So let's go through a case study that we haven't purchased at People's Capital Group, but this is sort of a simplified version of how it works with an example purchase. So on the right here, we have a building similar to the types of real estate that People's Capital Group purchases with its investors. And the typical price is around $1.5 million. What we normally do is we get a bank loan at 70 or 75% of the funds. And this allows us to take advantage of very low interest rate, about 4.5% to 5% these days, and pass that low interest rate and savings on to our investors as well. Now, when we get our bank loans, we personally guarantee them, and our investors do not. So that's one of the advantages of working with a company like People's Capital Group, is they take care of a lot of the heavy lifting. Now, the other 35% is from investors, and it's not 30% in this case, it's 35% because there's closing costs, and at times there is a construction escrow, and we'll get into that shortly. So from a cash flow standpoint, the way it works is the gross rents are received every month, and then we subtract out all the expenses. And here's an itemized listing of all the expenses. And then that gives you a net operating income. So it doesn't really matter what property you're buying or investing in. The process is the same. And the net operating income is the gross rents minus all of the expenses. Now, the only cost that's not included in the net operating income is the debt service or the mortgage. And this is done for various reasons, but this is how banks and lenders evaluate properties. So we have to evaluate our properties the same way. Now, when you subtract the debt service, you get a net after debt service, and that's the true cash flow at the end of the month. So in this example, the net after debt service is $2,825. And then there's an equity split between People's Capital Group and our investors. And it's usually either 50-50 or 55-45, depending on the building. In this case, the investor's portion is 55%. So they take 55% of the net after debt service each month, which is $1,554 a month. Now that gets paid to the investor on a quarterly basis. Okay, now the other way that investors make money is through equity appreciation. And this is the annual increase or appreciation of the value of building. In New Jersey, the average property will appreciate about 4%. Some buildings appreciate less, some buildings appreciate more. The buildings that appreciate less tend to be managed poorly, and the buildings that appreciate more tend to be managed well. So we're going to kind of take an average here of 4%. And as you can see, 4% year over year cumulatively comes out to $324,000 increase over 5 years. And just as we did with the tax cash flow, there's an equity split. So in this case, the investor owns 55% of the building, and they take 55% of the net equity growth after 5 years, which is $107,000. And then there's a calculation here. This actually comes out to a 6.8% return. So after 5 years on a typical investment with People's Capital Group on a building like we see here, we add up all the cash flow, we add up the equity appreciation, and then we can do an ROI analysis, which is return on investment. In this case, the investor brought in an initial investment of $525,000, and they made $271,000. So that equates to 51% over 5 years, or 10.3% year over year. Now, when we take that number and we compare it to some of the other returns that we looked at in the beginning of the webinar, from savings accounts, which were around 1%, CDs, 1 to 3%, municipal bonds and stocks, we can see how real estate can actually outperform most other investments on the market when done right. Now, here's a summary of the investment. Every time we buy a building, and People's Capital Group usually buys a building every quarter with our investors, these are 5-year investments on average. And so what happens after 5 years is the investor has a choice. They can keep the investment going, keep their money in the investment, and just take out their profits, their cash flows, which they get quarterly, and then their equity gain, which is achieved every 5 years on the refinance, or they can sell their shares and take their profits and take their original principal. So that choice is left up to our investors. Typically, People's Capital Group ends up holding the buildings for a minimum of 10 years, and at times even longer. So that's the technicalities, the typical structure. What we're going to look at now is 2 brief case studies of past properties that People's Capital Group purchased with investors, and most of our investors tend to be IRA self-directed individuals. So here's a property that's in South Jersey. It's 25-unit garden-style apartment complex. People's Capital Group bought it in 2014 for $1.075 million, and People's Capital Group secured the primary financing with the bank. In this case, it was not 70%, it was 75%. We got a great rate, which we shared with our investors on the investment at 4.5%. And then we partnered with those 4 investors, each who brought in $100,000 each. And that was the remaining 30% of the acquisition funds. The split on this investment was different than the other example we looked at. In this case, People's Capital Group had 40% and the investors had 60%. And again, each property is different, and we structure them based on how beneficial it is really for the investor. We want to make sure they get a minimum of ideally 10% annualized, although it's usually a little more than that. Okay, so what happened here is this is a building that when we bought it, it had low rents and it had high expenses. So this is actually perfect for a seasoned real estate company that knows what they're doing, because what we can do is we can increase the rents over time as old leases come due, and we can also minimize the expenses as old leases come due. And that's by reconfiguring the heating systems and even the electric at times to have the tenant pay for them on new leases as opposed to the landlord paying for them. And by doing that, we increase our net operating income. And that's what we did here. Over about 24 to 30 months, People's Capital Group raised the rents as the leases came due, and we decreased the expenses. It increased the net operating income by 24%. We put the property back on the market, in this case, less than 5 years, and we were able to sell the property. So it sold for $1.35 million in 2017, 24% over the purchase price. And that's called repositioning. And again, that allows our investors the chance to take part in a repositioning that they might not have the experience to do on their own. Here's an analysis of the ROI. It came out to, at the bottom here, 11.3% after doing all the calculations. So let's look at one more case study. This is a more recent property. This is not a property we're going to be selling. This is a property that we are repositioning, but we're going to hold it for probably at least 10 years, if not longer. This is also a smaller property. This is a 6-unit building in Passaic, New Jersey, not South Jersey, but North Jersey. And here are the details. So it's a building that we found through our own marketing and our own network. People's Capital Group has a pretty vast network of relationships with realtors, brokers, landlords. And when somebody's ready to sell, a lot of times they'll call us and we'll meet with them. We'll build a relationship. We'll find out what they're looking to do. We'll try to give them what they're looking for. And in this case, the landlord wanted to sell quickly. He needed the money, and he was willing to sell it at a discount. So we negotiated a price at $450,000. It was appraised at $540,000. So we were able to share, capture the equity at closing and share that with our investors. The roles of the parties here, People's Capital Group and the investors. So People's Capital Group finds the property. We negotiate the price, ideally below market. We don't like to buy properties at market. We like to capture equity from day one. We also secure the first mortgage, the financing. We guarantee those mortgages. Our investors do not have to guarantee the mortgage. We also are prepared to invest additional operating capital if necessary, which hasn't been the case, but that's in the operating agreement, just to give our investors a little more security. And then we reposition the property using our experience, our know-how, to increase the rents, decrease the expenses in a very careful way. There's a lot of legal loopholes you gotta be careful of. There's rent control, there's building departments, and you have to do it in a legal, ethical way. So we do that, and over 5 years, we increase the value. The investor's role is simply to bring the funds. So it's a passive investment. And the equity ownership split, again, depends on the deal. In this case, it was 55% to People's Capital, 45% to the ownership, to the investor, again, just based on the returns. And then summarizing this investment, the appreciation was 4% through forced equity growth, which is the repositioning, which is the increasing of rents and the decreasing of expenses. And then the natural appreciation in the market is 2% in Passaic. We add that together, we get a 6% estimated annual appreciation gain. One note here is that in Passaic, the real estate values have actually gone up much more than 6% in the last year, but we have to look at the whole long-term view and not year to year. It has to be long-term. And historically, in northern New Jersey and the New York City metropolitan market, which is where Passaic is, the typical return is about 2 to 4% without doing any forced equity growth. And then the projected 5-year return here comes out to $163,000 when you add in the equity gains and the cash flows. So the investors calculated to make 10.2% on this investment. We also aim to be very conservative, and we'd like to underpromise and overdeliver. So ideally, this will come out to significantly more than 10.2%, but that's the projection. Okay, so those are the two case studies. In recapping, what real estate offers is greater returns when done right, worse returns when done wrong. But again, looking for ways to beat the average market returns, real estate can be a great vehicle. It's also a diversification out of the standard investments, as we saw earlier. It's also a very tangible asset, a hedge against stocks, as Brittany mentioned. Inflation, as we see here with these two case studies, with average returns of 10 to 11%, it's outpacing inflation by a factor of 3 or 4%, or excuse me, 3 or 4 times. Tax depreciation is passed through with the IRA. We can talk about that a little bit more at a future time if you want to set up an appointment to talk. And then we like to stay in, at this point, the New York City metropolitan market. We used to be all over New Jersey, and now we're staying a little more local and trying to tap into New York City rents and New York City commuters. Okay, so that's pretty much the end of the webinar. I think we're going to open it up for some questions. But if you are interested in investing, you can call our office for a free consultation at this number right here, 908-464-0400. Or, of course, you can check us out on our website, peoplescapitalgroup.com. We also host meetings for more clarification on a weekly basis at our office, and you can see those on our website as well. So thanks for attending, and Brittany, I'm going to pass it back to you.
All right. Great, Seth. Good information. Love the case studies because they really put these concepts into a more realistic view for people in terms of understanding, you know, how things would be structured, what their responsibilities would be, whether or not they're using an IRA. So appreciate it. I'm going to see at this point if we have any questions. I believe that we do. Actually, there was only one so far, but for anyone who's still on, if you have any questions as you think of them, please feel free to enter them. One question, I think this was probably asked during my portion explaining disqualified persons. Are siblings disqualified? No, siblings are not disqualified, which means that you are able to use your self-directed IRA to buy from your siblings or sell to your siblings or lend to them or borrow from them. And you can certainly partner with them on investments if you wanted to do something like that as well. Again, just remember the lineal direction when we're talking about disqualified people. If you think about your family org chart, if you will, and you think straight up and down, those are the disqualified persons. Left to right would be things like the siblings, aunts and uncles, cousins, things like that. Those individuals are, for whatever reason, the IRS has determined are okay to invest with. So hopefully if you have a good relationship with your sibling or aunts, uncles, and cousins, you do have the ability to invest with them without any issue there.
That's great. And Brittany, I wanted to just maybe bring up a question that I get a lot, and that is regarding fees. Maybe you could discuss some of the fees for moving IRA funds into the self-directed investment.
Sure. So there is a one-time setup fee that you will typically pay to open an account. We're actually in the process of updating our fee schedule, and we're making some changes. They're positive changes. So we're offering a lower setup fee for electronic applications, but you will expect to pay a setup fee. And then there's an annual asset administration fee that applies as well. And that's going to cover your custodian's tax reporting, record keeping, statements, online access to your account. So typically you will see that you have two options you can choose from, and the same applies to Next Generation's fee structure as well. So the first option would be to pay a flat rate per asset that's held in your IRA. So for example, if you are doing a syndication, if you're lending on a real estate project with your IRA, each of those investments are considered an asset. And the annual fee for that is $325 per year. And then the second option is, rather than paying a fixed rate per asset, regardless of the value fluctuations, the second option is an account value-based calculation. So we would look at the overall value of your IRA, regardless of the number of investments, and calculate a percentage of that, which would be your fee. So depending on how many investments you're making, you can determine, and obviously, of course, how much you're funding the account with, you can determine which option is most cost effective. And then you'll typically also see a transaction fee apply to purchase or sale of an asset as well. We actually just got another, and I'm happy to send our fee schedule out to anyone who's interested. It's also available on our website at nextgenerationtrust.com, so you're free to download it there as well. There's another question that just came over. When funds go to Next Generation and sit in a bank account before investment, do they earn interest? So it's not in an interest-bearing account if you don't do anything with the funds, but we do have a sub-account option through TD Ameritrade, which enables clients to, if the funds are going to be sitting in a cash position for a while before they make a self-directed investment, they can put it basically into a brokerage account, and it can be invested into traditional types of assets, stocks, bonds, mutual funds that would be custodied by TD Ameritrade, but held under the Next Generation account name. And then because of our relationship with them, you would simply be able to do an ACH to move the funds back and forth. So when you're ready to do your real estate investment, for example, you would do an ACH from that TD Ameritrade sub-account over to the other portion, and then you'd be able to direct us to make your alternative investments. Let's see if we have any other questions. Doesn't look like we do. Seth, are there any closing comments that you would like to share?
Well, I just want to thank everybody for attending the webinar, and we're an open book, so if anybody has any questions, they can call us at any time and try to answer them. And if we can't answer them, we'll work it out with you and your team over at Next Generation Trust.
Great. All right. Well, thanks everyone for your time tonight. We will be following up with our contact information if you'd like to get in touch one-on-one or you think of questions later. We appreciate you joining, and you'll all receive a recording at the conclusion of the webinar. Have a wonderful night, everybody. We look forward to speaking with you, and we hope that you found the time valuable. Take care.